Hey gang, welcome to Time in the Market, investing channel with a long-term focus, taking a look at Sportradar Group, ticker SRAD. If you're not familiar with this name, they are similar to Genius Sports if you've seen any of my videos on that company. If not, they are basically an intermediary between sports leagues, which own their own data rights, sell them to a company like Sportradar, and then Sportradar works with sports betting companies to provide them with that data for a fee, of course, whether it's a fixed fee or a variable fee, depending on what kind of agreement they have. On top of that, they offer a variety of other services to those sports books. They can manage their trades, they can manage their entire platforms, they can provide them with live, up-to-date odds and services in that ilk. On top of that, they work with the sports leagues themselves for data integrity purposes, for betting integrity purposes, and the sports team within those leagues for data analytics, provide them with a variety of services utilizing the data that they collect. Plus, they work with a variety of media partners on a growing ads business and media business. On top of that, they have an audio-visual business where they can provide the sports books with live streaming services for their apps, so you can actually watch the game and place bets within the app itself. So it's really a business that covers a variety of angles in the sports area. And I kind of think of these businesses as kind of the picks and shovels plays in the betting world, because they sort of do a little bit of everything and they win no matter who wins in the sports betting space. So, if DraftKings is doing well, Sportradar is doing well. But if they're not doing well and FanDuel is doing well, Sportradar is still doing well because the bets are being placed somewhere, and Sportradar is taking a cut of that and making a bit of money here and there. Obviously, they're probably better off because of their managed trading services, their managed solutions, if a lot of players are doing well, but at the end of the day, that's far from being a foregone conclusion. So in the short term, they'll do pretty well in a lot of areas there because there's so many competitive players in that space, and all of them probably want some sort of service that Sportradar offers. The stock itself up 12.5% after really stellar Q1 earnings. However, after their Q4 earnings, they were up 20% and then gave it all back really quickly. Long term, not a good performer. This stock IPO'd in 2021, was at 27 bucks then and proceeded to fall off a cliff since then, down 60% since IPO. The good thing for investors now is that they raised a bunch of money at IPO, being valued at $8 billion, and now they're valued at $3.2 billion despite having doubled the revenue, way more free cash flow, and being in a much better spot from a balance sheet perspective. So sucks for investors at IPO, could be good for investors now. I do own shares in this company. I actually bought more when it was in the low 9s just a couple of weeks ago. Now it's in the 11s. We'll take a look at the valuation in a second. But results themselves, and again, results here are in euros because this is a company that's in Europe. So it might put some pressure on their valuation right there because companies in Europe and outside the US in general just get a lower valuation than companies in the US for one reason or another. Domiciled in Switzerland, revenue growth of 28%, EBITDA growth of 29%, margin expansion of 8 basis points, really solid. And you can kind of see this is a free cash flow positive business. We'll talk about that in a second, but already a free cash flow positive business and in a really good spot with their balance sheet. Again, revenue more than double in 3 years, 28% CAGR. Working with 800 betting operators, 400 sports leagues, 900 media partners. They collect a ton of data, analyze that data, provide it to those sports bettors, provide them with a variety of services, work with sports leagues for data integrity, betting integrity, all of that stuff. You can see all of the rights they have. They have 3 of the 4 major sports leagues in the US, the NBA, the MLB, the NHL, a variety of other rights. These rights are getting more expensive. That's one worry with stocks like this. They paid $1 billion for 8 years of rights of the NBA. Those run through, I think, 2029. And the question is always going to be, well, how much is the new deal going to cost? I think their NHL deal runs through 2031. Their MLB deal might be up for renewal not too long from now. And the NBA deal did include some equity, so not just $1 billion in 1 year. And that is spread equally across 8 years. And that's kind of a good thing because if you look at how they amortize or expense this deal, if it's 100 million, if it's, let's say, to keep it simple, it's an 8-year, 800 million deal. They amortize it 100 million every single year. So obviously your revenue in 2024 is going to be much lower than your revenue in 2028. But the cost of these rights is going to be 100 million in 2024, which is going to be putting a lot of pressure on margins in 2024. But in 2028, where your revenue could be potentially, double what it is now, it's still going to be 100 million, which means a ton of margin expansion possible because these sports rights deals are kind of locked in for the remainder of the term. And they're still going to renegotiate certain deals, add new deals, etc. So sports rights will go up across the year, but they're not going to go up as much as they're going up this year when the new NBA deal goes into effect, when the new ATP deal goes into effect. And you'll see that in a second. End of day, I think there's a lot of momentum here. They're growing 20% plus. They increased their revenue guidance for 24 up to 21% from 20. I think that's still probably sandbagging it a bit based on Q1 results. And they're introducing new products like Alpha Odds, which is increasing betting operators' profitability. And if they can do this, if they can make it more profitable for betting operators, those betting operators are going to be more likely to use their services, more likely to use their rights, and do all of that stuff in general. And that's a good thing for a company like Sportradar. They're leading in innovation. They are adding some new additions to their management team. Behshad Behzadi is their new CTO and AI officer. This was a guy that was with Google, worked on Google Assistant, Google Lens, Next Gen Assistant. And again, they're talking AI. Anytime you have a company that's got a ton of data, and they have a ton of data in the sports ecosystem, not only from the leagues themselves, but also from their betting partners, betting operator partners, they can do a lot of stuff with that data, analyze it, come up with new products. And I think that's a good thing to add somebody who has some experience with AI and things of that ilk. So financial results, really solid. The growth in the US is really part of the story here. It was just 19% of their revenue in 23, 25% of their revenue in 24, because it's growing at a 60% plus clip year over year. And a lot of that is because the US is still an immature market. It is starting to mature. And the beautiful thing about Sportradar is that there's two things that are great. One, as new states come online, Sportradar doesn't spend any additional money, but they get more money. So if they have a deal with DraftKings, for example, and let's say California comes online in the next couple of years, DraftKings is going to spend a ton of money advertising there, start bringing in a bunch of revenue, and because they give a portion of that revenue for each bet placed for the rights that they have with Sportradar is just going to make more money without really having to do any more legwork. And on top of that, they might actually make more money from the fact that they are partnering on advertising or fan engagement or whatever with DraftKings and a lot of these other companies. On top of that, the US is an immature market. That means that they are generally placing bets pre-game or more often than in-game. So live betting is in-game betting. If you place a bet when the game is live, it's called an in-game bet. If you place a bet before the game starts, it's a pre-game bet. Because the pre-game data isn't as important, it's easily replicable. They only charge 1 to 2% for that data of net gross gaming revenue or gross gaming revenue, whatever the deal is, or they might even have a fixed fee agreement in place. So 1 to 2% for that. For a live bet, they charge as much as 5 to 6%. So as more of that betting moves into the live area, they make a lot more money. And they said if 1% of their bets go from live to in bet, their overall bets, not just in the United States, they make an additional $1.4 million. Pretty good. And that's going to happen in the US. That's going to happen in more mature markets as mature markets mature rather. So for example, in Europe, something like 50% plus of the bets are in-game. In the United States, it's closer to 20 to 30% at this point. It's certainly going to move closer to that 50% mark across the years. On top of that, you've got other countries coming online. Brazil, again, more money. Don't really have to spend any more money. Just sign new deals with whoever is an operator in Brazil. More money. If India ever comes online, more money. If Japan ever comes online, more money. So that's really where you're sitting on as an investor. This is they already have a premier product. They have the rights to 3 of the 4 major deals. They have a ton of other products that are really solid. They're growing at 20%, and they're getting a valuation that seems reasonable. They have a really good balance sheet. The only issue is always going to be sports rights. Again, up 78% Q1. That might stand out as wow, the revenue's only up 28%, but their sports rights are up 78%. Margin shrinkage. Yes, in the first year, sure. But like I said, revenue is going to go up 20% next year. Sports rights are going to be much more flat unless they sign new deals. The year after that, revenue is going to go up again. Sports rights, flat because of the way they expense them, they amortize them. This is looking bad, but in the long run, this is the worst year of these new deals. By the time these deals are up, the margins are going to be much better on these deals. The problem is, what is the next deal going to look like, and how much is that going to shrink margin? Balance sheet looks really good. Cash flow is there already. If you look at their balance sheet, let's look at their balance sheet. Let's make sure it's in USD. $300 million in cash, no debt, almost no debt, a little bit of debt. Remember, IPO'd in 2021, sitting on $800 million plus in cash, paid down all of their debt. If you look at their cash flow statements, make sure it's in USD. Made some acquisitions during that period as well. Throughout this entire period, they are generating free cash flow, cash from operations. One thing to note for free cash flow for a company like this, it's not just cash from operations minus capital expenditures. It's cash from operations minus CapEx minus those sports rights deals. So the free cash flow on the bottom here is not correct. They are not making $274 million in free cash flow, because that would be an amazing investment. So keep that in mind as you look at this. But you can kind of see those rights, $102 million in 2019, over $200 million in the last 12 months, and probably going to go up in 2024 because of the new NBA deal and the ATP deal. And again, nice thing. They raised $636 million in cash in 21, selling the stock at $27, and they've been buying back shares at $11. And now they have a $200 million stock purchase plan they just authorized. They're going to buy it back at $11. Good use of funds in my mind. This is sucky for somebody who bought an IPO, but for investors that look at this now, the management has done a good job of managing their funds, selling when the stock price was high, buying back when they think it's low. That's how it should be done. And again, maybe the IPO was just overpriced. That's kind of how I feel about it. Disclaimer, guys, as we look at the valuation, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. So as we look at the valuation, stock is trading at 1091 pre-market, $3.2 billion in market cap, minus the debt, about a $3 billion enterprise value, a 2% free cash flow yield. And again, this is a free cash flow yield that is based on margins that are going to improve year over year over year based on these deals, 3.3% based on expected free cash flow for 2024. And this is kind of based on what the estimates are. I'm kind of being more conservative with my estimates around margin expansion and around revenue growth as well. So keep that in mind. If you want to play with the spreadsheet, hit file, make a copy. It will be in the description down below. So we've got 20.5% growth for 2024, and then dropping quite substantially in 25, 26, 27, 28. I think the expectation here is that not a lot of huge states or countries go online. If, Brazil really takes off, or if California, Texas go online, or if Japan and India go online, this could go way higher than what we're showing here. Margin expansion is there. There's going to be some pressure early on because of those new deals with the NBA and the ATP, maybe even some pressure for 2024. Like, I wouldn't be too worried if 2024 comes in much lower than 9.4% because of that new NBA deal. The expansion really has to happen towards the latter part of the contract periods. And I think even at 12% here, the long-term EBITDA goals are 25 to 30%. Usually you have something like 60% free cash flow conversion on a business like this. This is probably conservative. You can probably go as high as 15% towards the latter part of this deal, and that seems reasonable. So I'm being conservative here just because I have a 30% buyback here. And again, they have a $200 million buyback authorized already. This is all in dollars, by the way. You might seem and look at this and say, well, $242 million doesn't seem like a lot. A couple of things. It's $200 million buyback. There's also some equity considerations I'm keeping in mind. The NBA has warrants that are at 1 cent, so they buy them at 1 cent for about 7 million shares, I think. There's some warrants for the NHL as well based on their latest deal. So all in all, there's about 9 million shares outstanding out there that could dilute the pool if those warrants are exercised. That's probably $100 to $150 million worth of shares. So I'm kind of cutting back the buyback. The reality is their buyback is probably going to be closer to like 400 million. But because there's 150 million in outstanding shares due to those warrants, I'm bringing it back to 240 million. That's kind of my thought on the process here. From a valuation perspective, I think a company like this growing in the low 20s right now, high low to mid-teens in the next couple of years. Should be getting a valuation in that 3% range, but I'm being conservative again, kind of giving it a 4 to 5% valuation, more on the 4% area. Again, if this was in the US, I think the valuation would be closer to 3 to 4% versus 4 to 5%. But because it's in Europe, I'm closer to 4 to 5%. And with that in mind, I kind of get a 10% return based on these assumptions. And I think these assumptions are relatively conservative. So if you want to play around with those, you can certainly change them. Kind of gets me a fair value of 11.12, which is right on top of the 1091 that it's trading at today. If you think that this is going to grow faster, you can kind of change this to a higher rate of return. If you think this is going to get to a 15% margin when it's mature, free cash flow margin, this is a 15% return from here, a fair value of about 13.8 right now, 26% higher than it is now. For me, because I already own a decent amount of these shares, I'd probably want something more than a 10% target return. Again, when I was buying this was trading in that 930 range, and I don't think my valuation metrics were all that different than they are now. So if I look at a 15% target return, which is probably optimistic, that's an 891 fair value. If I look at a 12.5, that's a 994 fair value. So I think it's reasonably valued here. Am I buying more at today's prices? I wouldn't. If I didn't own the stock, I'd probably buy some right now. Since I already own it already, I'm probably going to hold off and hope that it falls a bit more because of the uncertainties around some of the things I mentioned. One, there is the fact that so much of this stock is driven by the cost of those sports rights. They've gone up quite a bit in the last couple of years. Now, those deals are locked in for a couple of years, probably until the last part of this decade for most of those leagues. How much are they going to cost going forward? You can say, well, at maturity, the free cash flow yield is 15%. Sure, but what if they have to pay double again for the NBA deal in 2029 or 2030, whenever that deal is up? That's a problem. Secondly, if you look at their ownership, like 50% of these shares are owned by 3 entities. The Canadian pension fund owns like 40% of the shares outstanding. If they ever decide to sell, that could put a lot of pressure on this stock. There's a venture capital fund that owns another 16%. There's an investment company that owns another 7%. And on top of that, there's their CEO that owns about 1.7%. But beyond that, he owns all of the Class B shares, which are essentially all of the voting shares. So he has complete control of the company. So this kind of worries me a bit. As I look at something like this, when it's so heavily held by 2 or 3 entities, that if those entities ever to say, I'm getting out of here, because for the CPP, again, they hold 40%, almost 40% of the shares outstanding, but it's only 0.6% of their portfolio. If they decide to sell, that could put a lot of downward pressure on this stock. And that could be a good thing for me as the long-term shareholder, but it could also mean that I could have future opportunities to buy this at a much lower price point. On top of that, like I said, the NBA and the NHL have warrants. If they ever want to take advantage of those and kind of dilute shareholders, that could be a bit of a problem. Now, the $200 million buyback that they have in place would kind of handle that. But at the end of the day, if you're buying back shares and getting diluted by warrants being exercised, that's not a great thing. So those are really the main worries. There's obviously some legal worries, what happens if gambling regulations come into play? There's a ton of gambling advertising out there right now. Gambling's not the healthiest thing for a lot of people. They can get addicted to it. So to have that in your face all of the time, just like there was, smoking advertising decades ago, will there be regulations put into gambling advertising? How will that affect their media business, their advertising business? Probably a negative there for the future as well. Could slow down their growth potential, could slow down their margins a little bit, margin expansion a little bit. So those are just things I look for. Obviously, you're kind of dependent on some of those states coming online in the future for real long-term growth. But I don't think a lot of these assumptions are based on the fact that California needs to come online, or Texas needs to come online, or India and Japan need to come online. Those are just upsides to that. So there's some upsides there that makes me feel comfortable with this stock, but there's also some potential downsides that worry me a little bit about this stock. So kind of the same thing with Genius Sports, because I already have Genius Sports and that's, 3 to 4% of my portfolio, and this is another 2 to 3% of my portfolio. There's a lot being in the gambling space. If I were to buy something today, would I buy Sportradar over Genius Sports? Probably. It's just a more mature company. It's already there on the margin expansion side. It's free cash flow positive. It's starting to buy back shares. I like what management is doing. I like the leagues that they've signed. I like what they're doing on technology side. Oh, speaking on the technology side, there are some lawsuits in place as well against Sportradar and Genius Sports. Panta Interactive, for example, is suing them for potentially stealing their online streaming technology that they say they invented. So some patent issues. There was already some lawsuits a couple of years ago around some of these sports rights contracts between Genius Sports and Sportradar. So obviously there's going to be some expenses on the litigation side, even if they don't end up paying anything on the end result. There's still some negatives ahead for a company like this. So I'm not like all in on a company like this. But again, if this drops again like it did in the prior earnings and I can get it again at a low 9 price point, would I stock up a bit more? Yeah, probably, because I think this is a solid company at a pretty good valuation at the moment. It's just, I already have a good deal of it, so I'm not going out of my way to get a ton more at a fair valuation. I'd need a good valuation for me to really bump up my exposure. So what do you think about Sportradar? Are you familiar with the company? Is it new to you? Let me know down below if you like it, if you dislike it, if you agree with anything, if I missed anything, all of that stuff. Thanks for watching. Like, subscribe. Bye.